Hey everyone, Doc here and welcome to the first Crypto Unplugged Crypto Weekly Roundup. We're covering the madness from Monday the 1st of December until today, and it's been one of those weeks where Bitcoin flushed, liquidations went nuclear, CT lost its head, and then as usual, the market quietly started to stabilize while everyone was still screaming into the timelines. As always, no hype, no hopium, just a calm walk through what actually happened, what probably mattered, and a few of the funny ways CT tried to cope with the pain. Let me take you through this. So let's start with the big picture. Monday opened like a normal day, and the market decided to run a live stress test on everyone's emotional resilience. The total crypto market cap dropped from around 3.3 trillion to roughly 3 trillion in a matter of hours. That's about 150 billion wiped out before most people even finished their morning coffee. Bitcoin led the move, slipping from the low 90,000s to below 86,000 at the worst point, easily one of the nastiest single day moves since March. ETH didn't escape either. ETH was trading around $3,000 going into the week and flushed down towards between 3,700 and 3,800 at the lows, and XRP continued its 2-month slide, sitting more than 30% off recent highs. Solana and the rest of the large caps had a rough start too, but funny enough, some of them closed the week better than Bitcoin did. By midweek though, the tone started to shift a bit. Bitcoin clawed its way back towards 93,000. ETH was hovering in the high 2000s, Solana was printing something that looked suspiciously like a higher low, and the overall market cap started to grind back from that 3 trillion line. So on the surface, it looked like the same old pattern. Big red Monday, leverage gets wiped, CT declares the cycle dead, price quietly finds a floor while everyone argues in their timelines. But underneath all that, there were some serious issues that got exposed, and that is what we need to unpack. Before we do though, quick context check. The crypto fear and greed index stayed buried in extreme fear for more than 20 days. Readings down between 20 to 23. Liquidations across the week were in the hundreds of millions, nudging towards $1 billion at one point. Mostly long exposure, getting carried out on stretchers. So if it felt particularly brutal, you were not imagining it. The data did back it up. Right, now with that backdrop, let's talk about why this happened. Anytime you get a day like Monday, everyone on CT wants one simple villain. Whales dumped, ETF dumped, market makers did it. The reality is always messier. This week was a 3-part problem. First, leverage. Derivatives data show perpetual futures open interest up in the hundreds of billions. You had a huge stack of leveraged longs sitting just below price. So when Bitcoin started to slip, it was like hitting a row of dominoes. You had that domino effect. One liquidation triggers the next, funding evaporates, and within minutes you have a cascade that looks worse than it really is from a spot only view. Second, liquidity, or rather the lack of it. December is already a thinner liquidity environment in traditional markets. People are winding down, desks are not exactly lining up to the warehouse for more crypto exposures at lows. So when that cascade did start, there simply were not enough calm bids below to absorb everything. That is where you get those exaggerated candles. And how did we get to $5,000 in hours type of questions? And the third point, macro. In the background, you had Japan's long-end bond yield spiking to levels not seen since the late 1990s. Markets waking up to the idea that the Bank of Japan may finally have to tighten policy properly. So why does that matter? Because the yen has quietly been funding all sorts of global risk trades, including crypto. So when funding leg starts wobbling, the unwind spreads everywhere. And on top of that, Fed expectations are all over the place. Markets had priced in a high chance of a rate cut into the year end. If that gets delayed or watered down, it hits all risk assets altogether, equities, cryptos, even some commodities. You could see that in how closely Bitcoin traded with tech stocks and the Nasdaq on the worst days. So when you join all three of these up, high leverage, thin liquidity, and a macro wobble around the yen and the Fed, you get exactly the kind of flush we saw on Monday. Nothing magical, just a structural cleanup. Now that's the mechanical side out of the way. There were also some real stress showing up in the corporate and stablecoin world, which is worth a bit of a closer look. So let's start with the big one, Strategy. Strategy, or MicroStrategy, the giant public company that became famous for turning itself into a leveraged Bitcoin treasury, had a bit of a sobering week. They cut the 2025 earnings outlook hard. What was previously been sold as a smooth linear profit story suddenly got marked down into a range that openly includes multi-billion-dollar losses in conditions stay rough. They also set aside $1.44 billion in cash as a buffer enough to cover dividends and debt payments for more than a year, funded by fresh equity. And quietly in the background, they admitted it. If the company's market value falls too far below the value of Bitcoin on its balance sheet, actually selling some more Bitcoin is now on the table as a last resort. Now that's a shift of tone from the old "we will never sell" type of meme. Analysts have started using phrases like Darwinian phase for Bitcoin treasury companies, and they're not wrong. In a world where rates are higher, volatility is back, and leveraged Bitcoin is no longer a free ride, only the well-capitalized, well-hedged players make it through intact. Everyone else has some hard choices to make. Then there's a stablecoin side. Tether was back in the crosshairs this week. Rating agencies and research shops questions its resilience if rates fall and reserve yields drop. You had the usual round of "are they fully backed" headlines. Their CEO responded strongly, talking about multi-billion surpluses, excess revenues, and the comfort of sitting on a huge pile of short-dated US treasuries. Whether you take that at face value or not, the bigger story is that stable coins are no longer this fringe topic. The IMF released another report flagging them as both a potential boost for payments and a real risk to financial sovereignty if they take off without guardrails. Central banks are using that narrative to push their own CBDC agendas. At the same time, euro-denominated stablecoins had quietly strong year. Since MiCA and related European rules started to kick in, euro stables have pretty much doubled their total market cap. Yeah, it is tiny compared to the dollar, but the direction is clear. It's regulated. Fiat-backed tokens issued by known entities are the version of crypto that policymakers are most comfortable with. Miners in the meantime were having a horrible time. Hash price and profitability metrics for Bitcoin miners have been grinding down towards record lows once you factor in energy costs and the latest halving. A lot of the smaller, more aggressive miners are now in that zone where they either raise fresh capital, merge, or start selling coins into weakness just to keep the lights on. So while the headlines are all about traders getting wiped out in perps, under the surface, you had a major Bitcoin treasury company building a $1.44 billion war chest, the biggest stablecoin issuer arguing publicly with rating agencies, central banks using the chaos to sell their framework, and miners quietly selling into the move just to survive. Different landscape from 2021, and if you're trying to understand this cycle, you can't ignore that shift. Right, as for some of the big stories that colored this week, firstly, the whale waking up moment. On-chain analysts spotted two cash-less physical coins finally moving after around 13 years of completely remaining dormant. Each of those coins represents 1,000 Bitcoins, so about 2,000 Bitcoin in total, moving after sitting untouched since the early 2010s. At today's price, you're looking around 9-figure wallet suddenly flickering back to life. No one knows yet if that's just a very patient early adopter rotating coins for security, or someone finally scratching the hologram on a coin they forgot about in a drawer. Either way, it's a neat visual reminder of how young this asset class is, with still literal physical coins are lying around with generational wealth encoded in them. Then moving on to the Do-Kwon chapter of the script, US prosecutors are reportedly pushing for around a 12-year sentence for Terraform's founder, framing the Terra collapse as a fraud case on the scale of or bigger than some of the other big blows that we have seen, like Celsius and parts of FTX. In a move that only makes sense in this industry, the old Terra Classic token Loon C ripped over 100% on the week on the back of the news and some aggressive burn mechanics. Essentially more courtroom drama, more speculative flow. It's like the market looked at a mad multi-billion-dollar ecosystem failure and said, yeah, you know what? We can meme that a bit higher for the last time. On the law enforcement side, Europol coordinated a big bust of a scam investment network that used fake platforms, call centers, and a slick website to convince people to deposit savings into non-existent high-yield products. The estimated damage is in the hundreds of millions of euros spreading across multiple countries. A decent chunk of that money was washed through crypto rails. So if you need another reminder what KYC, proper venue selection, and basic caution still matters, there you go. In Korea, Upbit is still dealing with the fallout from its Solana hot wallet hack. Roughly 30 million in assets drained. The Lazarus Group once again floated as a likely attacker, and that one is a good excuse for me to repeat the same message that you've heard 100 times. Yeah, exchanges are convenient, but they're not a vault. Hot wallets exist for speed, not for safety. On the business and infrastructure side, there were a couple of interesting moves. Paribu, a big Turkish exchange, agreed to acquire CoinMina, a regulated MENA exchange, in a deal valued up to $240 million. That's a serious number in regional fintech terms. It tells you that local compliant exchanges in the Middle East are now seen as real strategic assets and not just hobby projects. On Solana, a project called Unruggable opened pre-orders for a Solana native hardware wallet, a physical device tuned for Solana, .sol domains and the ecosystem's quirks. If you're planning on spending the next few years farming Solana airdrops, there might be a gadget that stops you from doing it all on your mobile browser at 3 AM. So a bit of everything really: courts, cops, whales, mergers, and someone building another shiny metal panic button. Now let's get to where the real emotional damage lives. Crypto X or CT. The mood from Monday onwards was pure chaos. You had December threads. People were posting charts with random lines declaring 60k, 50k, fuel reset, new bear market, pick your flavor of doom. Giveaways were everywhere again, and we had tweets: I'm giving away 0.1 Bitcoin to someone who likes this post. 2 people who like this get $10,000. The usual engagement bait that somehow always spikes in weeks where people are desperate to feel chosen by the market. Then you had classic CT flex content. One of my favorites this week was a guy claiming 43-year-old, no kids, crypto millionaire, smoking hot girlfriend, name anyone having a better Christmas than me. Bruv, you just know there's a mattress on the floor and 3 monitors in that room somewhere. On the dating satire side, someone posted, my standards for 2026, hair 6 foot plus, actually funny, credit score of 751 plus, invest in crypto, pays for everything, sex once a week, I'm not asking for much. The replies would roasted that one for days. Then you had the self-deprecating survival posts. Since crypto doesn't provide anymore, I decided to become a professional dancer. Give a like if you think I'm talented. And that awkward dancing video, not much talent, still better risk management than 50 times leverage. People shared their 2025 crypto racked screenshots showing a year of perfect tops, disastrous bombs, and way too many screen hours. Others went more serious. GM, reminder, you don't see the pain behind every crypto investor. Then of course the absurd macro takes, crypto peak comedy. So the emotional spectrum was wide, from dark humor to quiet regret, and in the middle of that we had to keep things simple over on our side of Crypto X. Oz laid it out pretty plainly. Early in the week he tweeted out, pullback likely over the next few days, then another strong move up. And as price chopped around and stabilized, he followed with going as thought, then doubled down with shall we today or tomorrow would be the high or low for the next push up next week, which so far is exactly where the tape is trying to do, carve out that high low. On the rotation side, he pointed out something important that most people ignored. The funny thing is that as soon as the IWM, that's the Russell 2000, is breaking out, the majority have given up on alts. In other words, small caps in traditional markets are waking up, the risk curve is quietly firming, and CT is calling the top on alts as the first sign of pain. There was also a broader roadmap post. ETH BTC will break out this month. ETH will break out properly in January, February next year. Alts will run and we will have a local top and run again. Sound good? You might not have to agree with every detail, but you do get the point. There is a plan. There is a bigger cycle map. And we're not throwing that in the bin just because of one Monday candle hurt feelings. So if you want the honest difference between CT noise and what we actually focus in, that's it. CT sees one red candle and screams new bear market. We see leverage, macro, cycles, volume, and say, okay, where is the high low forming and what does that set up for the next leg? So how do you actually frame this week without the panic and without the hopium? For me, it looks like a classic mid-cycle flush. You add leverage, macro wobble, thin liquidity, and some genius stress on miners and treasury players. You did not have a structural breakdown in adoption, a collapse of core infrastructure, or any new evidence that Bitcoin's long-term thesis is invalid. If anything, you saw more of the usual story. Regulators getting clearer about stablecoins and property rights, big exchanges merging and consolidating, long dormant coins waking up, and serious players accepting that this is not a free money environment anymore. So the question for you is not, is it over? It is, what does this change in my plan? If you were fully leveraged and all in at 120k, this week hurt and you probably need to reassess risk. If you're working a proper DCA plan and waiting for exactly this kind of fear to add size, this week was a gift, even if it felt ugly in the moment. What I'll be watching into next week, the Fed and the market's reaction to any shift in rate cut expectations, Bank of Japan's commentary, and whether the yen carry unwind calms down, ongoing minor stress, any forced selling headlines start to matter if price is still fragile, and of course the price action around this potential higher low that Oz flagged. Do we actually build a base here, for the next push into Q1, or do we need one more leg lower to really clear the decks? Either way, panicking at the lows has never been the alpha play. Okay viewers, that wraps up our Crypto Weekly Roundup for this week. If this helped you cut through some of the noise for you, hit that like, subscribe to the channel, share it with someone who spent the whole week doom scrolling and deserves a calmer view. If you want a deeper side of this, the on-chain reports, the cycle works, ECA targets, members videos, Telegram group, we break it all down in detail, and that all lives in the Alpha Insider on the marketsunplugged.com. You can start with a free dashboard, and if you want a full playbook, the Alpha Insider and Cycle Intelligence Program memberships are there when you're ready. Drop your thoughts in the comments as well. What was the stupidest take you saw on CT this week? What do you think happens next? High or low into a push, or one more washout before we run? I'm Doc, this is Crypto Unplugged. See you in the next one.